What if I told you that something like 80% of the wealth sitting in your retirement account right now, the equity you think you have in your house, the numbers on the stock market, what if I told you it doesn't actually exist?
I mean, it's a terrifying premise, right? But when you actually start looking at the macroeconomic plumbing of the last, I don't know, 30 years, it becomes incredibly difficult to refute.
Yeah, it really does. So welcome to the deep dive. We are tackling something absolutely massive today.
We really are.
Because usually, when we talk about a diagnosis, whether it's medical or economic, there's this expectation of precision. Like, you break your arm, the x-ray shows a jagged white line, and the doctor says, there it is, broken.
Right, you want that certainty.
Exactly. And we like our economic x-rays to be just as comforting. We think, okay, if GDP's up, we are healthy. If the S&P 500 is soaring, we're wealthy. We see those bright white lines of our 401ks growing, and we assume we know exactly what we're looking at.
But that comfort has become, honestly, a massive liability because we are relying on an economic x-ray machine that is just fundamentally broken. It's feeding us false positives while the actual patient is internally bleeding.
Yeah, and today we are throwing out those standard broken x-rays. We're looking at the raw, unmanipulated data. Our guide for this is a deeply fascinating, just incredibly dense transcript from an economic debate.
It's from the Iconoclasts over on the Honor channel.
Yeah, exactly. It features two razor-sharp economic minds, Yanis Varoufakis and Wolfgang Münchau, and they are digging into these tectonic shifts that mainstream financial media is entirely missing.
Which is wild because these shifts affect everyone.
They really do. So our mission today is to untangle this. We're going to explore the dangerous disconnect between the illusion of wealth and actual human productivity. We're looking at how both the East and the West have built these precarious, fundamentally incompatible economic engines.
And we really need to start by looking east at China because the narrative we are being fed in the West about the Chinese economy is just a masterclass in misdirection.
Oh, completely.
The official story you hear on business networks is that China is going through this K-shaped recovery. Have you heard this?
Yeah, where the tech sector is booming. That's the upward arm of the K, while the traditional economy is sluggish. But supposedly, that tech boom is strong enough to pull the whole country forward.
Exactly. But Varoufakis and Münchau, they just tear that narrative apart in the source material. When you get past the broad descriptions and actually look at the numerical data, that K-shaped thesis completely collapses.
Because their tech sector, as astonishing as it is, simply doesn't have the gravitational pull to drag a $17 trillion economy out of the mud.
Right. I mean, the debate transcript points out that China is officially in what they call a growth recession.
Which is a phrase that sounds like a total contradiction.
It does. A growth recession means that, yes, the absolute number of the GDP might be ticking up by a fraction of a percent, but relative to population growth and inflation, the economy is effectively contracting.
So it feels like a severe recession to the actual people living inside it.
Exactly. Wages stagnate, capital dries up, and jobs just vanish.
But if you just casually check the Chinese government's official financial statistics, you wouldn't see that. And this is where the detective work in this unheard debate gets really, really interesting.
Yeah, they highlight these massive, glaring discrepancies in the data coming out of Beijing. Like, take their trade surplus, for example.
Okay, we'll unpack that.
So if you look at the official financial transactions, like the spreadsheets managed by the central government, it shows a relatively modest trade surplus, nothing crazy.
But then you look at the customs office data.
Yeah.
And the customs data tracks the actual physical shipping containers leaving Chinese ports and crossing borders.
Right. And those numbers show an absolute explosion. I mean, China is exporting physical goods at a staggering, record-breaking rate, far beyond what the official financial books claim.
Wait, so Beijing is basically keeping two sets of books?
That's what the source suggests, yeah. They are deliberately massaging the official financial data to present this calm, stable picture to global investors, while the physical reality of their exports tells a completely different story.
And that reality really bleeds out in the labor market. The official unemployment rate in China is heavily managed and, notoriously low.
But the debate brings in analysis from independent Chinese economists who looked at a different metric entirely, which is discouraged workers.
Walk us through how that metric changes the picture, because I think that's crucial.
A discouraged worker is a vital concept in labor economics. This is someone who is able-bodied, they want to work, they need an income, but the local job market is so thoroughly devastated that they have simply given up looking.
And because they aren't actively applying for jobs, the government just removes them from the unemployment calculation.
Poof! They vanish from the official statistics. But when you factor those tens of millions of discouraged human beings back into the math, the actual unemployment rate in China isn't hovering around 4 or 5%. It is around 10%.
10%. I mean, let's just pause on that for a second. For you listening, in any major industrialized nation, 10% unemployment isn't a sluggish recovery.
No, it's a crisis.
It is a brutal structural crisis. The image that immediately came to my mind while reading this was a swan on a lake.
Oh, that's a good analogy.
Right. Because if you're standing on the shore, you see this elegant white swan gliding perfectly across the water. That's the booming tech sector. They have globally dominant electric vehicles. They control the battery supply chains. Their semiconductor IPOs are breaking records.
They're dropping open source AI models that rival Silicon Valley.
Exactly. That's the swan, looking flawless above the surface. But underneath the water, hidden from view, that swan is paddling furiously, desperately, just to keep from drowning.
And that furious, exhausting paddling is the 10% unemployment. It's the broader traditional economy just suffocating under the surface.
And the reason this matters to you, the listener, is that economic actions of this scale never stay contained.
Never. When the world's manufacturing superpower is hiding a jobs crisis of that magnitude, it alters the geopolitical gravity of the entire planet.
Because an economy suffering from internal financial distress, where their own citizens don't have the jobs or money to buy the things they produce, has to rely on the rest of the world, right?
Exactly. They have to rely on the world to absorb their excess production. They effectively export their way out of their own internal depression.
Which perfectly explains the exploded shipping container data we talked about earlier. They have all these factories running, nobody at home to buy the goods, so they're flooding the globe.
Yep.
But how did they build this trap for themselves? Like, how did the undisputed manufacturing king of the world end up with 10% real unemployment and a furiously paddling economy?
Well, the unheard debate takes us back to 2008 to explain the plumbing here. And 2008 really is the Rosetta Stone for understanding modern global macroeconomics.
Right, because when the great financial crisis hit, the West panicked. We bailed out the banks, we subjected the public to harsh austerity, and demand just collapsed.
But China took a radically different path. Münchau and Varoufakis point out that in 2008, China essentially saved global capitalism from a total depression.
They just opened the floodgates. While we were tightening our belts, Beijing initiated the largest infrastructure stimulus in human history.
It was massive. They built highways, massive high-speed rail networks, entirely new cities. They created the synthetic boom in global aggregate demand that kept commodities flowing and factories open worldwide.
But the mechanism of how they paid for this is the ticking time bomb, isn't it?
Absolutely.
Yeah.
Because in the U.S. or Europe, when we do a massive stimulus, the federal government issues sovereign debt. It's national. But in China, almost all of that massive infrastructure debt post-2008 was forced onto the balance sheets of local governments.
Explain how that local debt machine actually works, because it seems so counterintuitive to how we view China's top-down centralized power.
It's a really fascinating dynamic. Beijing sets the economic growth targets. So the central government says, hey, we need 8% GDP growth this year, but they don't give the local mayors and provincial governors the tax revenue to actually achieve it.
So what do the local mayors do?
They create what are called local government financing vehicles, or LGFVs. These are essentially shadow banks. The local government takes land it owns, uses it as collateral to borrow billions from these shadow banks, and then uses that cash to pay construction companies to build infrastructure.
Whether that infrastructure is actually needed or not.
Exactly. The mandate is growth, not utility. So they build an 8-lane highway connecting 2 rural villages that don't need it. They build a massive airport in a city that doesn't have the air traffic to support it.
This is where the infamous ghost cities come from.
Yes, precisely.
Yeah.
And the debate transcript explicitly links this to a Minsky moment.
For the listener, what is a Minsky moment?
It's named after the economist Hyman Minsky. His core thesis was that prolonged periods of economic stability and growth inevitably breed instability.
Because people get too comfortable.
Exactly. When times are good for a long time, investors and governments get complacent. They take on more and more debt to finance increasingly speculative, lower-quality projects. Success literally breeds reckless overconfidence.
So China's incredible growth from, 1990 to 2010 pushed them into a paradigm where they were borrowing astronomical sums of money to build fundamentally unproductive assets just to keep the GDP spreadsheet looking good.
Right. So now we arrive at the present day. You have this gargantuan industrial machine. It's overexpanded, fueled by toxic local debt, and domestic demand has cratered because of that 10% unemployment.
The factories are still churning out goods, but the Chinese consumer is completely tapped out. So they flood the global market with cheap solar panels, EVs, and consumer goods.
Which brings us to the Western reaction and what the unheard debate calls the tariff paradox.
Okay, let's get into this because this is wild. When Europe or the U.S. sees a flood of cheap Chinese goods threatening local manufacturing, the immediate bipartisan political reflex is to slap tariffs on them.
Right. Put a massive tax on Chinese EVs at the border to make them more expensive and protect our own factories.
I mean, it sounds like basic common sense.
It sounds like common sense if you are dealing with a standard free market trading partner. But Varoufakis and Münchau argue that applying tariffs to China right now is a catastrophic trap.
Okay, hold on. I need to push back on this on behalf of the listener because it defies basic supply and demand. If we put up a tariff wall to protect our markets from being flooded, this source is arguing that we actually force China to flood our markets even harder. Walk me through that plumbing.
It's all because economic levers are connected to currency markets. If you impose a 20% tariff on an economy that is already internally suffocating and desperate for export revenue, you back them into a corner.
Because they can't just shut the factories down.
No, Beijing cannot allow those factories to close. That would turn 10% unemployment into 20% unemployment, which leads to massive social unrest. So how do they overcome a 20% U.S. tariff? They devalue the Chinese yuan by 20%.
Making their currency weaker relative to the dollar.
Precisely. If the yuan is weaker, Chinese goods become cheaper for Americans to buy. The devaluation completely offsets the tariff.
Wow. Okay, but wait, there's a flip side to that, right?
There is. A weaker yuan makes it incredibly expensive for Chinese businesses and consumers to import goods from the rest of the world, so they stop buying our stuff.
Oh, I see. The result is their exports stay the same or grow because they are artificially cheap, but their imports from us just collapse.
Exactly. Their trade surplus actually explodes further. By trying to punish them with tariffs, we exacerbate the exact global imbalance we were trying to fix.
And the debate transcript points out an even more painful layer to this trap, specifically for Europe, because Europe has mandated this massive transition to a green economy. They desperately need solar panels, wind turbines, affordable electric vehicles.
And right now, because of that massive state-subsidized infrastructure we just talked about, China makes those things far better and drastically cheaper than European manufacturers.
So if European politicians slap tariffs on Chinese green tech to protect legacy German automakers, they're essentially kneecapping their own climate goals.
Yeah, they are intentionally making the green transition unaffordable for their own citizens just to punish a mercantilist trading partner.
It's like shooting yourself in the foot to prove a point about gun safety.
Yeah.
You just can't use a standard free market penalty like a tariff against a state-directed, debt-fueled export machine.
You really can't.
Which brings up the obvious question. If tariffs are a trap and their current export model is unsustainable, what is China supposed to do?
Well, the standard prescription from the IMF and Western economists is that China needs a consumption-led recovery.
Right. The West is telling Beijing, your people need to spend more money. Stop building factories and start encouraging your citizens to go to the mall. You need a consumer economy.
But the unheard debate highlights that Chinese economists and policymakers are aggressively pushing back against this Western ideology. And honestly, their logic is incredibly compelling.
Yeah, they ask a very pointed question. They ask, why should Chinese citizens be encouraged to fill their garages with useless plastic junk they neither need nor want, just to boost a macroeconomic consumption metric?
It is a profound philosophical critique of how the West measures economic health.
It really is. I was reading this thinking, it's like a doctor telling a patient they aren't healthy because they aren't eating enough junk food.
That's a great way to put it.
The West looks at China and says, your economy is sick because your people aren't buying enough disposable gadgets on Amazon. And China's looking back saying, is the sheer volume of mindless transactions really your definition of a successful civilization?
I mean, in the United States, roughly 70% of our GDP is consumer spending. Our entire economic engine relies on individuals continuously buying things. If consumers stop shopping, our system instantly faces a recession.
But from the perspective of Chinese policymakers, an economy rigged to require endless, wasteful consumption isn't a strong economy at all. It's a fragile, decadent one.
But to be clear, Beijing isn't ignoring their internal crisis. They know they have depressed consumers and high unemployment. They are attempting a massive rebalancing, but they are doing it through mechanisms that look completely alien to Western economists.
Right, they aren't mailing out stimulus checks for people to buy TVs. Instead, the debate points out this staggering statistic. The cost of healthcare for Chinese citizens has recently plummeted by 95%.
Wait, 95%? That number is almost impossible to comprehend in the American context.
It really is.
But we have to understand how they did it and why it matters economically. This wasn't magic. The state aggressively intervened. They used their centralized power to enforce massive bulk procurement programs for pharmaceuticals, crushing the profit margins of drug companies. They capped medical fees and radically expanded state insurance coverage.
Okay, that's impressive, but how does slashing healthcare costs fix a macroeconomic slump? Like, how does that replace consumer spending?
Well, think about the psychology of a Chinese worker. Historically, China hasn't had a robust social safety net. If you or your parents got sick, the medical bills would instantly bankrupt your family.
Right, it's terrifying.
Because of that existential dread, Chinese citizens have one of the highest savings rates in the world. They hoard cash out of absolute necessity.
Oh, I see. They aren't spending because they are terrified of a medical emergency.
Exactly. So if the government steps in and structurally eliminates 95% of that cost burden, they have effectively cured the anxiety that causes the hoarding.
That's brilliant.
They haven't handed the citizen a pile of cash, but they have unlocked the citizen's existing capital by removing the existential threat. It acts as a massive, indirect economic stimulus without encouraging the purchase of useless consumer junk.
And that philosophical divergence, what constitutes real value, it extends directly into how China and the West are currently investing in technology, too.
Oh, absolutely. The AI divide.
Right. The transcript draws this brilliant distinction regarding artificial intelligence. When we talk about AI in the West right now, we are overwhelmingly talking about large language models, ChatGPT, Midjourney, stuff like that.
Right. We are spending hundreds of billions of dollars on compute power to generate quirky pictures, write marketing copy, or, create synthetic video.
It's largely geared toward entertainment, software as a service, or marginal administrative efficiency.
Contrast that with how the unheard economists describe Chinese investment in AI. Beijing isn't prioritizing chatbots to write emails. They are aggressively coupling their AI research directly with physical manufacturing and robotics.
The transcript gives the example of agriculture, which is fascinating. If you go to rural farming provinces in China today, you see an immense integration of AI and physical robotics designed to massively enhance agricultural yield.
They're literally using AI to physically pull more calories out of the dirt.
And this is where we need to look at the macroeconomic impact, right? Because building a software model that generates a picture of a farm might create a billion-dollar valuation for a tech startup in Silicon Valley, but it doesn't lower the cost of food for you and me.
Not at all. But using AI robotics to automate a real farm fundamentally lowers the cost of physical goods. It is deeply deflationary in the real economy.
So the West is inflating financial valuations with software, while China is trying to engineer physical abundance, which makes China's next long-term geopolitical move even more fascinating.
Right.
So they aren't just rebalancing internally.
No, they are playing a very long game to insulate themselves from the West entirely.
This is where the economic X-ray reveals the tectonic plates shifting. The unheard debate drops a massive number on the table. China currently holds roughly $4.5 trillion in foreign savings.
4.5 trillion.
Because they've been the world's factory for decades, exporting far more than they import, they have amassed this unbelievable mountain of foreign wealth. And Varoufakis and Münchau warn that China is laying the groundwork to use this wealth to fundamentally challenge U.S. financial hegemony.
Through the BRICS Plus system.
Exactly.
To grasp the gravity of this, we really need to understand the plunging of global power, specifically the system we built in 1944 at Bretton Woods.
I actually want to stop you there and ask you to really break this down, because the transcript references Bretton Woods as the blueprint China is trying to copy. But for someone listening right now, Bretton Woods sounds like a dry history lesson. Why does a conference from 80 years ago dictate how we buy groceries today?
That's a great question. It's because it established the financial gravity we still live under. In 1944, World War II was ending. Europe was in ashes. Asia was devastated.
Right.
The United States was the only major industrialized power with its factories intact. We were the ultimate surplus nation. We manufactured everything the world needed to rebuild, and everyone owed us money. So the Allied nations met in Bretton Woods, New Hampshire, and the U.S. essentially dictated the terms of a new global financial architecture.
We rigged the game in our favor.
We absolutely did. We
Yeah.
anchored the global economy to our currency. Under Bretton Woods, the U.S. dollar was pegged to gold, and every other currency in the world was pegged to the dollar. It established the U.S. dollar as the undisputed global reserve currency.
Even though Richard Nixon took us off the gold standard in 1971, right?
Right, which the transcript notes was a massive turning point toward the financialization we see today. But even after that, the dollar remained the anchor. Global commodities, like oil, are still priced in dollars. If Japan wants to buy oil from Saudi Arabia today, they have to acquire U.S. dollars to do it.
Which means there is a constant, unquenchable global demand for U.S. dollars, allowing us to run massive deficits without our currency collapsing.
Exactly. It gives the U.S. an exorbitant privilege and immense geopolitical power. We can freeze a country out of the global banking system with a single sanction.
So bring that context to the modern BRICS Plus alliance. BRICS, Brazil, Russia, India, China, South Africa, and now expanding to include major oil producers like the UAE and Saudi Arabia. The unheard debate argues that China's endgame is to recreate that 1944 Bretton Woods moment, but with Beijing at the center.
China steps into the role the U.S. played in 1944. They become the surplus anchor.
Yeah.
Precisely. In this new architecture, China acts as the massive manufacturing surplus nation. But instead of recycling their profits back into U.S. Treasury bonds, which is what they've done for the last 30 years to keep the dollar strong and the yuan weak, they recycle that wealth entirely within the BRICS Plus bloc.
So they offer development loans in local currencies, they facilitate trade using their own financial messaging systems, and they bypass the U.S. dollar completely.
Yep. The transcript mentions the Belt and Road Initiative, China's massive project, building ports, rail lines, and highways across Africa, South America, and Asia. It describes it as just a whiff of this grand strategy.
It's not just about roads, it's laying the physical plumbing for a new, enclosed financial universe.
And if they succeed, the implications for you, the listener, are profound. If half the global population and the majority of the world's commodity producers no longer need U.S. dollars to trade with one another, the global demand for the dollar plummets.
And if demand for the dollar drops, the value of the dollar drops, which means inflation skyrockets at home, the cost of borrowing for the U.S. government explodes, and the era of Western financial dominance ends.
It's a huge deal. But the debate transcript points out a massive, immediate hurdle stopping Beijing from just flipping this switch tomorrow. It's that $4.5 trillion in savings.
Ah, right. This is the financial Mexican standoff.
Exactly, because most of that $4.5 trillion isn't sitting in gold bars in a vault in Beijing. It is tied up in Western jurisdictions. They hold over $1 trillion in U.S. Treasury bonds alone. They own real estate and corporate assets in Europe and the U.S.
This is the ultimate trap of being the world's factory under a dollar hegemony, isn't it?
It is. To keep their currency artificially weak so they could keep exporting cheaply to Americans, the Chinese central bank had to constantly buy U.S. dollars. They amassed a mountain of our debt. If Beijing suddenly aggressively dumps those U.S. treasuries to start their own BRICS currency, the value of those bonds crashes.
They would be vaporizing their own national savings.
Exactly. So making a clean break is incredibly risky. The transcript notes that China is being highly conservative, slowly diversifying their reserves into gold and local currency swaps, but avoiding a panic. They are patiently waiting for the U.S. to make a strategic misstep that forces their hand.
And what would that misstep look like? Well, to understand that, we have to pivot away from China's hidden recession and look in the mirror.
We have to look at the glittering facade of the Western economy.
Because as deep as China's problems are, the unheard debate reveals that the West has built an illusion on a scale that defies human comprehension.
This brings us to the core thesis of the entire deep dive, the McKinsey wealth bombshell.
Yes. The transcript cites a recent report from the McKinsey Global Institute titled Balance Sheet 2026-2025. Now, we need to contextualize this. McKinsey is not some fringe Marxist think tank.
No, they are the high priests of global corporate capitalism.
Right. When they publish data, it is the establishment looking at itself. And the numbers they reported are just staggering. They completely shatter the illusion of Western economic supremacy.
The scale of the numbers we are about to discuss requires a total shift in how you think about money.
Let's walk through it slowly.
Yeah.
The McKinsey report estimates that total global assets and liabilities sit at roughly $1,800 trillion.
1,800 trillion.
Now, of that $1,800 trillion, the physical, real stuff in the world, every house, every factory, every piece of heavy machinery, every patented piece of intellectual property accounts for only $620 trillion.
Which leaves a gap, a chasm, really.
A gap of roughly $550 trillion that the economists in this debate literally categorize as financial hot air.
Let's define financial hot air because it sounds like hyperbole, but it's a mechanical reality. We are talking about derivatives, collateralized debt obligations, highly leveraged synthetic financial instruments.
It is paper wealth that exists only on bank balance sheets and server farms.
Exactly. It has absolutely zero tether to a physical machine, a bushel of wheat, or a useful service.
The report goes on to define total global wealth, which is simply those total assets minus total liabilities at about $600 trillion. And of that $600 trillion, a staggering $570 trillion belongs to households.
Individual human beings, though, obviously concentrated heavily in the hands of the top 1%.
But here is the data point that should make the hair on your arms stand up. The unheard debate compares this current data to the year 2000. In the year 2000, total global household wealth was $130 trillion. Today, it is $570 trillion.
So global wealth quadrupled in 25 years.
And here is the explosive foundational argument of the debate. Did our actual physical capacity to produce real goods and services quadruple in that same time frame? Did humanity build 4 times as many factories? Did we harvest 4 times as much food?
Did we invent 4 times as much useful technology? The answer is overwhelmingly, undeniably no.
The McKinsey report estimates that of all this new wealth created since the year 2000, only 20% of it is tied to an increase in actual productive capacity.
Which means the other 80%, and Varoufakis argues it might actually be closer to 90%, is not a reward for innovation. It's not wealth generated by entrepreneurship or building something society needs.
It is a reward for being what the debate provocatively calls a parasite.
Yeah, they are invoking classical economics here, specifically David Ricardo's concept of economic rent. Economic rent is wealth derived simply from earning an asset as it artificially inflates in price, rather than wealth derived from producing something of value.
Okay, I have to stop here and speak for the listener because this induces a level of existential dread.
It really does.
If I'm listening to this on my commute and I'm thinking about the equity in my house that has doubled in the last 5 years, or my retirement 401k that has marched steadily upward, the economists in this debate are essentially arguing that a huge chunk of that isn't real growth. Are they telling me my retirement is fake?
I wouldn't use the word fake because you can currently log into your account and see the numbers, but I would use the word disconnected. We have to mentally separate financial wealth from real economic capacity.
Yeah, what's the difference?
Financial wealth is just a number on a screen representing a claim on future resources. Real economic capacity is humanity's actual ability to produce those resources, the food, the energy, the housing.
Let me try an analogy here to see if I grasp the mechanics. Imagine a company that makes shoes. They have 100 shares of stock, and they own one factory that makes 100 pairs of shoes a day.
Okay.
Suddenly, the CEO decides to issue 400 new shares of stock and gives them to the executives, but they don't build a second factory. The total wealth of the stock pool just multiplied by 5. The executives feel incredibly rich.
Right.
But if all those executives try to cash in their stock to buy shoes on the exact same day, they discover there are still only 100 pairs of shoes rolling off the assembly line. The slice of the pie expanded, but the actual calories in the pie stayed exactly the same.
That is a flawless analogy for what the global economy has done since the year 2000. The numbers on our screens have multiplied by 4, but the amount of real stuff in the world has barely grown.
And this explains inflation.
Exactly. This is the direct connection to what you experience every week at the grocery store. This disconnect is the fundamental structural driver of the crushing cost of living.
When financial wealth expands vastly faster than productive capacity, you create a massive ocean of money, chasing a relatively stagnant pool of real physical assets.
So what happens? Housing prices explode. Healthcare costs explode. The wealth is there on paper, but its purchasing power in the real world is severely diluted because the stuff hasn't grown at the same rate as the money.
So how on earth did the West engineer this $570 trillion house of cards? How did we allow 80% of our wealth to become entirely disconnected from reality?
The unheard debate traces the genesis of this disaster back to specific macroeconomic policy failures in the 1990s.
It starts with the era of massive deregulation, the repeal of Glass-Steagall, and the unshackling of the financial sector to create these complex derivatives, right?
It does, but the transcript specifically points a finger at the Federal Reserve and a concept known as the Greenspan put, named after former Fed Chairman Alan Greenspan.
Right. To understand the clumbing here, a put is an options trading term. If you buy a put option on a stock, you are buying an insurance policy. It guarantees you can sell the stock at a certain price, protecting you if the market crashes.
But the Greenspan put wasn't a literal paper contract. It became the psychological reality of the entire banking sector. Starting around the 1998 bailout of long-term capital management, it became the unwritten rule that if the massive financial institutions took insane leveraged risks and lost, the central bank would always step in, lower interest rates, and flood the system with liquidity to bail them out.
It permanently rewired the psychology of capitalism. It created a culture of heads I win, tails the taxpayer absorbs my losses.
It's exactly like running a rigged casino.
Yes. Imagine a casino where the Wall Street high rollers sit at the VIP roulette table. They place incredibly risky leveraged bets. When the ball lands on their number, they keep all the massive payouts. They buy the yachts, they get the 8-figure bonuses, they buy the politicians.
But the moment the ball lands on the wrong number,
and they lose their shirts, the casino management literally walks outside, holds a gun to the taxpayers on the street, and forces them to cover the billionaire's losses.
and this dynamic completely destroys the fundamental mechanism of the free market. A true free market requires the brutal threat of failure to discipline risk. If a business makes bad investments, it must go bankrupt to clear the rot from the system.
If you surgically remove the threat of failure for the most powerful actors, you guarantee reckless behavior.
You incentivize the creation of that hot air wealth because there is literally no downside for the people creating it.
And this led to what the debate calls financial dominance. The financial sector, the banks, the hedge funds, the private equity firms became so bloated on this risk-free environment that it completely overwhelmed the real physical economy.
The transcript argues that this reliance on bailouts and quantitative easing, the central banks printing trillions of dollars to buy toxic assets after 2008, is the greatest driver of inequality in human history. It birthed the modern oligarchs while the middle class stagnated.
And Varoufakis and Münchau present a fascinating, controversial counterfactual. They argue that to actually save capitalism, we should have let the bad banks fail in 2008. We shouldn't have bailed them out.
Which sounds completely insane to anyone who lived through the panic of 2008. The narrative we were sold by the politicians and the Treasury secretaries was that if the big banks failed, the ATMs would shut off, payrolls would bounce, and civil society would collapse into anarchy.
But the debate makes a crucial mechanical distinction that the media never explained. They aren't saying we should have let the working class lose their money. They argue we should have let the bankers, the bondholders, and the shareholders get wiped out completely.
The institutions should have been liquidated, and the government should have used its power to bail out the savers directly.
They give a chillingly specific, enraging example of this from Greece during the European debt crisis.
Oh, this part is wild.
The transcript notes that in 2010, the total amount of savings held by Greek citizens in their banks was roughly 120 billion euros. Just 120 billion to make every single human being in Greece whole.
But instead, the European financial system authorized bailouts totaling 560 billion euros and funneled it directly to the bankers and the institutional creditors to save the system.
It is a breathtaking misallocation of resources. You could have guaranteed every single regular citizen's savings account completely, preserved the social fabric, and let the corrupt banks die for a fraction of what was spent bailing out the institutional investors who took the bad risks.
So why didn't they? Why did political systems across the Western world, from the Social Democrats to the conservatives, unquestioningly write blank checks to the banks?
Because of that financial dominance we just talked about, the financial sector had grown so massive, so structurally integrated into sovereign debt markets, that it had completely captured the political system.
Western governments run on deficit spending. They require banks to constantly buy their bonds to keep the government functioning. Politicians became terrified of the bond market.
They lost the analytical capacity to even imagine letting a bank fail. And they lost the moral strength to say no to the financial class. The parasite had fully taken control of the host.
Which brings us to the terrifying present moment. Because we are now living in the inevitable aftermath of those cowardly decisions. We're sitting on top of that $570 trillion mountain of wealth, knowing that 80% of it is hot air.
And the unheard debate warns that the entire globe is now held hostage by this American wealth bubble.
Out of that $570 trillion in global private wealth, a staggering $175 trillion is held by Americans. The entire global economic architecture relies on the perceived paper value of U.S. assets not imploding.
And the transcript states unequivocally that the probability of this bubble bursting is at an all-time high. We have blown the balloon up until the rubber is transparent. The question isn't if, but what exactly will be the pin that pops it.
The economists outline a very specific potential trigger scenario. A triple whammy crisis that hits unregulated crypto stablecoins, U.S. treasuries, and the commercial banking sector simultaneously.
I want to dig into the mechanics of this because the debate calls the recent collapse of Silicon Valley Bank and the stablecoin issuer circle a tiny dress rehearsal for this exact nightmare. Walk me through the plumbing of how a crypto panic could crash a traditional bank.
It's all about collateral. Think about a stablecoin like USDC issued by Circle. It is a cryptocurrency that promises to always be worth exactly $1.
Right.
To maintain that peg and convince people it's safe, the company takes your real dollar, issues you a crypto token, and then uses your real dollar to buy safe collateral, primarily short-term U.S. Treasury bonds.
Okay, so the crypto token is backed by U.S. government debt.
Right. But what happens if there's a panic in the unregulated crypto market? Say a fraud is exposed, and suddenly millions of people want to cash out their stablecoins for real dollars at the exact same time.
The stablecoin issuer doesn't have cash. They have treasury bonds.
So to pay their customers, they have to rapid-fire sell billions of dollars of treasuries on the open market.
And if everyone is panic selling treasuries at the same time, the fundamental laws of supply and demand kick in. The price of those bonds drops.
Exactly. And who else holds massive amounts of U.S. treasuries as their primary reserve asset? Traditional commercial banks. This is exactly what killed Silicon Valley Bank.
SVB held billions in long-term treasury bonds, right?
Yeah. When interest rates spiked, the market value of those bonds dropped. When their tech startup clients started withdrawing cash rapidly, SVB had to sell those bonds at a massive loss to cover the withdrawals. That realized loss blew a hole in their balance sheet, they became insolvent, and they collapsed over a weekend.
Now imagine that tiny dress rehearsal happening on a global macroeconomic scale. A panic in the multi-trillion-dollar shadow banking or crypto sector forces an unprecedented fire sale in the sovereign debt market.
The value of treasuries plummets, which instantly blows fatal holes in the balance sheets of every major commercial bank in the West. That is the triple whammy. It's a cascading, uncontrollable failure of confidence in the foundational hot air assets.
And because we have $550 trillion of hot air resting on a tiny foundation of real economic capacity, a localized panic can instantly trigger a global margin call.
So we step back and look at the whole board. The unheard debate paints a picture of two completely different, terrifying realities colliding.
On one side, we have China. They're currently enduring the agonizing pain of a 10% hidden unemployment rate and a growth recession. But they are taking the pain now because they are aggressively trying to build real, physical, AI-driven manufacturing capacity and a parallel BRICS financial system to shield themselves from a Western financial crash.
They are attempting a physical restructuring of their economy despite the massive internal distress it is causing.
And on the other side, you have the West. The transcript is scathing about European and American leadership here, stating they are totally oblivious to the fragility of their own wealth.
We are still clinging to the Greenspan put, assuming we can just print our way out of the next crisis without ever having to build real factories or suffer real consequences. We are doubling down on financial engineering while the foundation rots.
We have continually chosen to artificially inflate the financial bubble rather than endure the painful, politically unpopular restructuring of our real economy. Which brings us to the end of a truly monumental deep dive.
It really is a lot to process.
We started by looking for a comforting X-ray of the global economy, and what the raw data revealed was a system built entirely on illusions. For you, the listener, we've covered incredible, complex ground today.
We uncovered the hidden 10% unemployment and the furious paddling beneath China's K-shaped facade.
We explored how their investments in robotic agriculture and their slashing of healthcare costs are a direct philosophical challenge to the Western ideology of debt-fueled consumerism.
We peered into the geopolitical plumbing of BRICS plus Psi, where a new Bretton Woods might emerge to bypass the US dollar.
And finally, we stared into the abyss of a $570 trillion global wealth illusion, a massive bubble built on decades of banking bailouts and the cowardly refusal to let bad actors fail.
And the ultimate takeaway here is that the metrics we use to judge our daily success, our GDP growth, the Dow Jones Industrial Average, our official inflation rates might be telling us a completely fabricated story about the real world.
They are measuring the size of the hot air balloon, but they're completely ignoring the structural integrity of the basket holding us all up. It leaves us with a profound, unsettling question about the future of value itself.
If 80% of current global wealth is just financial hot air, totally disconnected from humanity's ability to actually produce the food, energy, and goods we need to survive.
Here's a thought for you to mull over long after this deep dive ends. What happens to the very concept of money itself if a rival bloc like BRICS Plus decides to one day back their new parallel financial system entirely with physical commodities?
Like gold, oil, rare earth metals, wheat, rather than the Western promise of endless, artificially supported future debt.
If the economic X-ray machine is broken, maybe it's time to stop staring at the screen and start looking at the real world. Thank you for joining us for this deep dive. Stay curious.